Welcome to This Explainer. Today, we're unpacking a brilliant MBA dissertation by Swarnasekhar Dutta to finally settle the great Indian middle-class dilemma. Should you go with ULIPs or mutual funds? For years, investors have been caught in a massive tug-of-war between insurance agents pitching bundled security on one side and financial advisors championing pure investments on the other. Well, today, we're cutting the noise and looking strictly at the numbers.
Here's our agenda for today. 1. The debate. 2. Performance and risk. 3. The compounding penalty. 4. A mock Viva Q&A. And 5. The final verdict.
Section 1. The debate. Decoding the structures.
Right. To get why this debate even exists, we gotta look under the hood at how these two financial instruments are fundamentally built. On the left, we have unit-linked insurance plans, or ULIPs. These are hybrid products, regulated by IRDAI, that bundle your life insurance with market-linked investments. Crucially, they come with a mandatory 5-year lock-in. Now on the right, we have mutual funds, regulated by SEBI. These are pure, highly liquid investment vehicles focused entirely on wealth creation, no insurance component mixed in whatsoever.
The foundation for our analysis today is this incredibly objective, academically rigorous MBA dissertation by Swarnasekhar Dutta, covering 2024 to 2026. This study analyzes a ton of secondary data from 2020 to 2025, combined with a primary survey. It's exactly the kind of deep dive we need to cut through the marketing spin and get straight to the unvarnished truth. Section 2, Performance and Risk, the hard evidence.
Okay, looking at the hard evidence, we aren't just going to compare raw returns. That doesn't tell the whole story. We're looking at the Sharpe Ratio. If you're not familiar, think of the Sharpe Ratio as the financial equivalent of fuel efficiency. It tells us exactly how much return you're getting for every single unit of risk you take on. It is absolutely crucial for comparing different financial products on an even playing field.
And the data here is honestly crystal clear. Mutual funds consistently deliver superior risk-adjusted returns across the board. Just look at the mid-cap category, a 1.19 Sharpe ratio for mutual funds versus 1.08 for ULIPs. Or the aggressive hybrid category, 1.14 versus 1.02. What this means in plain English is that mutual fund managers are generating better returns without taking on disproportionate risk to get there. And man, when we look at dynamic allocation, that gap turns into an absolute canyon. Dynamic allocation requires agile fund management. You have to actively shift between equity and debt based on market conditions. Here, mutual funds severely outperform ULIPs by a massive 240 basis points. We're talking 12.9% for mutual funds, compared to just 10.5% for ULIPs. This strongly suggests that ULIP fund managers are structurally way less equipped for sophisticated tactical allocation.
Section 3. The compounding penalty, the invisible thief.
This is where we hit the emotional peak of the data. We're transitioning from what is happening to exactly why it's happening. Unlike a mutual fund's single clean expense ratio, ULIPs drain your returns through an absolute gauntlet of multi-layered fees. You've got premium allocation charges that can literally eat up to 48% of your premium in year 1 alone. Then you add policy administration fees, fund management fees of 1 to 1.5%, age-linked mortality charges, surrender charges, and then they slap an 18% GST on all of it. These fees are devouring your principal before it even has a chance to hit the market.
34.5%. Take a moment to let that sink in. 34.5%. This staggering number represents the terminal wealth eroded over 20 years by just a 2% cost differential between a mutual fund and a ULIP.
Let's look at how this compounding penalty plays out in the real world. If you invest 1 lakh rupees over 20 years at a 12% gross return with 0 costs, you'd have about 9.64 lakh. Okay, now, a direct mutual fund with a 1% cost leaves you with 7.79 lakh. But a ULIP with a conservative 2% cost drag, that leaves you with just 6.31 lakh. That seemingly tiny 2% fee difference stealthily cannibalizes over a third of your long-term wealth. It is literally an invisible thief living in your portfolio. Section 4, Mock Viva Q&A, the cross-examination. So let's rapid-fire test these findings against real-world investor behaviors. It's the million-dollar question, isn't it? If the math is so definitively against them and this compounding penalty is so severe, why on earth are millions of investors still buying ULIPs every single year? Well, the answer comes down to the principal-agent problem. Simply put, the system is rigged. Distributors and agents can earn massive upfront commissions. We're talking up to 35 to 40% of your first-year premium just for selling you a ULIP. That creates a crazy powerful incentive to push these products. Combine that with the emotional framing, words like insurance and protection, and it creates this false sense of safety that totally overrides rational economic calculation. Which naturally leads us to ask, do investors actually know what they're buying? This brings us to a fascinating behavioral phenomenon called the Dunning-Kruger effect. The reality? Investors are unfortunately blissfully overconfident. Data's survey uncovered a massive overconfidence paradox. 73.7% of surveyed investors proudly claimed they understand the charges and risks of their investments. Yet, when they were actually tested, only 39.5% knew the basic structural difference between a ULIP and a mutual fund. Actually, scratch that, it gets worse. Nearly 40% didn't even know if ULIP returns were market-linked. They don't know what they don't know, which makes them the absolute prime targets for mis-selling.
But wait, what about discipline? You'll always hear agents defend ULIPs by saying the 5-year lock-in forces you to save. If you miss a premium, your policy lapses, so hey, you're forced to be disciplined. But is that behavioral nudge really worth the massive price tag?
The dissertation hits the nail on the head here. It decisively concludes the cost of ULIPs forced discipline, potentially 31 to 37% lower terminal wealth over 20 years, is an extremely high price for behavioral nudging. Guys, sacrificing a third of your life's wealth just to force yourself to save is a phenomenally expensive way to build financial discipline. You can literally just automate a mutual fund SIP for free.
Section 5, the final verdict, protecting your wealth.
We've looked at the hard data, uncovered the hidden cost, and navigated the psychological traps. The research objectively proves that bundling is just a structurally flawed strategy. A ULIP gives you inadequate life cover, usually just 10 times your annual premium, paired with a very high-cost investment. It's essentially the worst of both worlds. The winning combo? Separation. Buying a pure term insurance policy gives you massive coverage, like 20 times your annual income, for pennies on the dollar. You then take the rest of your money and put it into direct plan mutual funds for low-cost, high-yield wealth creation.
So what's your actionable takeaway from this explainer? It's 4 simple steps. 1. Always separate your insurance from your investments. 2. Buy a pure term insurance policy that covers 10 to 20 times your annual income. 3. Invest the remainder in direct mutual funds so you completely avoid those distributor trail commissions. And 4. If you need advice, go consult a fee-only registered investment advisor or RIA. Someone who doesn't rely on product commissions to make a living. I want to leave you with this final provocative thought today. Open up your portfolio right now. Take a hard look at what you own. Are you paying an invisible thief 34.5% of your future wealth just for the illusion of convenience? Because if you are bundling your insurance and your wealth creation into a single product, you might just be funding someone else's retirement instead of your own. Thank you so much for joining me for this explainer, and stay focused on your financial future.